Oil isn't the only commodity getting more expensive these days. Gold prices are continuing to climb as well. Now near $1,415 a troy ounce, or about $17 below the record price that we just reached in mid-December. Joining us now to talk about this commodity's rally and how it's helped his company is Peter Marrone. He's the CEO of Yamana Gold. The Canadian company reported record revenues, $535 million yesterday, and earnings more than 3 times higher than a year ago for the quarter. It operates in South America, primarily Brazil and Argentina. So thanks so much for joining us. Let me start by asking you about your production profile. I mean, I see that you increased gold reserves 26%. Talk to us about what that means, what your production profile looks like going forward. Will you be pulling more and more gold out of the ground?
Well, there are 2 parts to it, perhaps 3. The first of the parts is that some of that reserve increase is the result of new projects, one in particular where we delivered the first reserve estimate. That means that it would be contributing to production over the longer term, and it would be adding to what is already that robust production growth profile of more than 60% within the next few years. The second part to it is the replacement of ounces at existing mines, and that means, in other words, that what we've depleted by mining, we've replaced, and that gives it another year or more than a year of mine life, which is always a very, very good thing with existing operations. And the third, and the one that I think is something that I think should be focused on very much, is new projects that are not yet in production, where we're in construction of a new mine, where we're delivering increases in reserves, which allows us the flexibility now to say, we're not only increasing mine life, but we have the capacity possibly to increase throughput, which means that we have a longer mine life at a higher production level.
You're obviously optimistic, excited about the future of your company for production, for the reserves that you found, for the mine life. Let me ask you about the money that you have to spend to do that. I mean, are you getting this at a good price? Because obviously you are making tons of cash as the price of gold continues to rise.
Well, our finding cost for every one of these ounces that we find in the ground, and that's the exploration finding cost, is under $25 per ounce. And so I would say that that's a formidably low price. It's exceptional to be able to do that, and that's why we favored organic growth over acquisition growth over the past couple of years or so. With a $25 or less finding cost, it means that we can devote more money to then the construction of mines. We can devote more money to the optimizations of our operations. We have a comparatively low cost structure. People talk about cash costs, but one other way to look at a mining company is what's the cumulative all-in cost to produce an ounce of gold, including exploration, including general and administrative expenses, sustaining capital, and the like. And when we look at it from that point of view, and this is where I do get excited, because it's about the generation of cash flow at the end of the day. And this company generated all of last year about $1.01 per share of cash flow. And when we look at it from the point of view of comparing that to our share price, that's where we see this true value proposition in the company. That's a very robust cash flow, and it's a big increase over 2009, where we were just under $500 million of cash flow.
And will those increases continue?
We think so. When we look at it, that trend, and there's an expression that I've used with our management team of the trend is our friend. If we look at the trend, we were at about $40 million of cash flow in 2006. That ramped up to $496 million in 2009, and last year we generated just about $750 million of cash flow, and I think that will continue this year. If we look at where gold prices alone, for example, we realized an average gold price last year of about $150 below where it is today. So we think that because of gold price, that continuing theme of ours of containment of costs, and increase in production this year, we think that that will continue.
Peter,
and then 2012. Sorry, please go ahead.
No, 5 seconds though. Because we're running out of time. I am curious though where you see gold prices headed by the end of this year, just very, very quickly, if you could.
I wish I could predict where we would be over a short term, but I think that we do have this perfect recipe for metal prices and gold price in particular to continue to go up. And I know that earlier in the show, a comment was made that it's a few dollars away from the all-time high.
Okay.
I'm not a believer of that. The all-time high was, in real dollars, more than $2,000 per ounce. There is all the prospect for gold to go to higher than that.
We're going to leave it on that note. Peter, great to get some time with you. Thank you so much. We appreciate it.